Thank you, Ryan. Good evening, everybody. Thanks for joining us on this Summary Wednesday. I'm happy to be joined by Craig. Craig, thanks for joining us. How are you doing tonight?
Excellent, thank you.
Good, good. Right before, obviously, we went on camera. We were just talking about Utah and the mountains there. A lot of people don't know this. I used to live in Utah for 2.5, 3 years, and certainly talking to you about all the hiking has me feeling a little nostalgic. Certainly, you have better views there in Utah than we have here in Illinois.
Uh, well, we lived in Missouri for about 14 years, and so I can appreciate the beauty of the Midwest. We loved it in the Midwest, but in terms of mountains, yeah, the Midwest is a little challenged when it comes to mountains.
Yes, I think Illinois is the second flattest state in the country, versus Utah is known for having some of the best snow for skiing in the world.
Yeah, for a lot of years, we've been here 16 years, and I didn't ski for the first 13, so I repented, and I'm now skiing every chance I get.
Well, I can tell you, given my questionable skiing skills, I was very happy to have the soft snow to fall on.
That's true. That's a good point.
But Craig, I know you're here to talk about retirement portfolio analysis, and I know that's what our attendees are looking to hear about. So I'll let you take over, and I'll quietly sit in the background.
Okay. Well, I sure appreciate people taking a little bit of time this evening to join in this, hopefully a conversation as best we can in this sort of webinar environment. As a bit of background, like I mentioned, we lived in Missouri. I taught at University of Missouri in the financial planning program there at UMC, and then taught at BYU for about 9 years. And now I teach an investments class at Utah Valley University. And I mention that because one of the aspects, as I was teaching personal finance, usually very large sections, we would eventually get to the topic of retirement planning and retirement portfolios, and that's just a little bit of a hard sell to kids in their 20s. And so it's just a real treat to be able to speak to people that are really, I hope, quite interested in this topic because it's very germane to where we are in our life. So let me just go through 6 or 7 slides that give you a sense for the spreadsheet tool that we're going to spend some time looking through. But I just wanted to kind of orient you to the spreadsheet so that when we go there, it'll look a little bit more familiar. So here's the main control panel, if you will, or the main dashboard. And there's a lot going on. And this looks like this is a screenshot, obviously, from Excel. And we're going to go to this actual spreadsheet in just a minute so we can do things live. But I want you to focus on all the cells in yellow. So here's where we can specify the age. We can specify the starting portfolio balance. And then we can look at the allocations. So we've got retirement asset classes: large stock, small stock, non-U.S. stock, bonds, cash, REITs, commodities, and so forth in this section here. And those can be set to whatever you wish. And I will tell you in advance that little fine-tuning adjustments in the asset allocation don't really do much. And I just mention that because there's sometimes a tendency as we start tinkering with portfolios, whether we're in the accumulation phase, which means pre-retirement, or in the post-retirement distribution phase, we get maybe a little bit wrapped up in the axle in terms of little micro adjustments to the large stock allocation, the small stock allocation. And I can demonstrate what I'm now saying to you in just a few minutes. But that becomes, those little micro adjustments really, that's not a very important issue. There are just much more important issues to focus on. One of them is cost, and so we have down here the this box. I'll just highlight it here, where we can enter the cost, and this is the for people that do it themselves. That's simply the cost of the mutual funds or the ETFs that you're using. And if there's an advisor involved, it would be her cost or his cost. So right now there's 1 basis point, or excuse me, 1 percentage point, 100 basis points that's been entered as a cost. Then the next cell down is, how is the money coming out? What's the mechanism of determining how much money is coming out? So we can choose RMD, we can choose a percentage of the portfolio. Down here in the black box that's not yellow, but it can be yellow, we can specify a fixed dollar amount that's coming out. And then kind of a fun little component, or a useful little component, is that we can adjust the historical returns. So what we're looking at here is a 50-year period from 1970 to 2019. And in that time frame, that 50-year time frame, we have 50 years of historical returns. 50 years of returns for large U.S. stock, small U.S. stock, non-bonds, cash, REITs, commodities. So all those 7 main asset classes, we have 50 years of returns. And you can see the gross return right here to the right. So over that 50-year period, large U.S. stock, that's the S&P 500, had a geometric mean of 10.6%, and then 10.88 for small stock. So if we're using this tool that utilizes historical data, but we're doing so with the intention of kind of looking forward for ourselves, we can actually adjust history down. We can reduce the historical returns if we choose to throw a little bit more pessimistic view going forward. I hope that made sense. Okay, so that's everything in yellow. This column B, those are all the things that we can adjust, we can enter. That's our data. And then the main graph that you see in the screen, that is the information. And we're looking at rolling 25-year periods, meaning that clearly some people have more than 25 years in retirement, but I'm using 25 years as excuse me, a pretty good approximation of how long a person may have in retirement. So that would take them from age 70 to age 95. I understand that there are certainly people that live longer than that, but I'm using a 25-year retirement period as hopefully indicative of how a portfolio can survive. Excuse me. So, since 1970, there have been 26 rolling 25-year periods. 26 retirees, so to speak, each one starting 1 year later. So in this graph, then right here, that's our first 25-year period, 1970 to 1994, then 1971 to 1995, and so forth. So what we're examining is 26 different individuals who got on the retirement bus 1 year later. And the reason for that is that the the performance of a portfolio is subject to what we call a sequence of returns. And there can be an optimal sequence of returns, and there can be a sequence of returns that is far less than optimal. And we want to see all of those. And the only way to do that is to slice up history and to look at individual time frames and see how whatever portfolio we've designed, how did it behave? What were the sequence of returns in that 25-year period? What were the sequence of returns in the next 25-year period? And they're overlapping. So you're just dropping off a year, going to the next year. So this particular screen you're looking at is for the bulk of the information can be derived, but there's a lot of other screens. And so let me just bounce down to those, and then we'll get into kind of the live portion. So now I just went down sort of one page in the spreadsheet, and this next graph with the green horizontal bars, this is showing us the average withdrawal in each year of the 25-year retirement window. So in year one, the average withdrawal across, remember, we're going across 26 retiree lifetimes, 26 of them. So in this there's 26 year ones, there's 26 year twos, and so forth. So the average withdrawal in year one was 54,000. The average withdrawal in year two was 61,000, and so forth. And that just gives you sort of a ballpark idea of, based on what data you entered, what your experience would have been historically. The next graph to the right is the average annual withdrawal over the distinct 25-year periods. So assuming this information up here, so we have a 72-year-old. At age 72, they have $1.5 million. They have a broadly diversified portfolio, 14.3% in all 7 asset classes. The analysis assumes that it's being rebalanced, and the rebalancing during retirement is simply achieved by whichever asset classes had the better performance over the past year. Then sufficient money is withdrawn from the better performers to bring them in line in terms of the allocation with those that didn't do as well. But in saying that, let me just sort of digress for a moment. Rebalancing is not like making precision components for a fine watch. Rebalancing is a little, it's not rocket science, meaning that precision is not demanded. We're more or less trying to keep our allocations in line. We don't want them to stray a great deal from where we say we want them. But to be to feel pressure to rebalance, to the second decimal point is not the point of rebalancing. It's to more or less keep things in the range that we want. So assuming all of these assumptions that you can see on the screen, the average withdrawal over the 25 years from 1970 to 1994 was $250,000. And obviously this one right here, that's the sweet spot, obviously. Well, let's look back. That's 1975 to 1999. Well, that's an interesting 25-year period, 25-year retirement window. 1975 was that was the first year that a withdrawal was made from the portfolio. Well, that means that if the retiree started in 1975, they didn't experience the equity meltdowns of 1973 and 1974. And if the 25th year, the last year of their retirement window, was 1999, it means they didn't experience the meltdown that started in 2000, the tech wreck, we sometimes call it, the 2000, 2001, 2002 U.S. and non-U.S. equity meltdowns. So that's an example of a sweet spot. If you could pick what 25-year period that you wanted to start and stop your retirement withdrawals, if you had just a 25-year period to choose, you would definitely choose that one, 1975 to 1999. Your average withdrawal over those 25 years was $330,000. Remember, that's starting with a balance of $1.5 million. So that's a really astounding number. But then in more recent 25-year periods, as you come up the graph, we see that in more recent years, that the average withdrawal over the entire 25-year period is approaching, 1/3 of that optimal sequence of returns period. So this particular graph is really an illustration of how significant the issue of sequence of returns is. That we have to look at all of as many rolling periods as the data allow to see what the historical experience was, to then give us some bandwidth, some upper and lower limits of what our expectations might be going forward. The next graph down is kind of a fun one because for those who are familiar with Monte Carlo analysis, it looks kind of like a Monte Carlo graph of possible outcomes. And yet it's not Monte Carlo. Monte Carlo is a simulation of simulated returns. This is the actual experience using actual returns of actual indexes. So what this is saying is we started, this is a map of the annual withdrawals for each of the 26 different people. So this green line up on top, guess which individual that was? Well, that was the individual that retired in 1975, and their 25th year was 1999. That's right there. Then you have another individual who their experience, because they were in a different 25-year window, this line down here, for example, represents their 25 different withdrawals, their 25 years worth of withdrawals. So to put it in a different way, I've highlighted year 12 with this vertical box. So here's one. This is that blue line, what I'm pointing to. That's at about $100,000. And then the green line up here, that's at about $260,000. So that's the range of possible outcomes in year 12 based on what your sequence of returns was and everything in between. And then noted up on the top is that the annual withdrawals increase the following year 80% of the time. And that, of course, will differ by whatever method we impose that determines the annual withdrawals. But what I have found that this graph is useful for is just the general shape of all of the lines, because the lines represent the annual withdrawals. So here's an annual withdrawal right here, that amount. Then here's the next annual withdrawal, and that one went down. And here's the next withdrawal, next year's, and so forth. So if the amalgamation of these lines, these line graphs, is generally trending upwards, which this is, that tells us that our annual withdrawal is generally increasing. That's the real takeaway of this particular graph. And then finally, the 25-year returns. So here's the first 25-year window, 1970 to 94. Over that 25-year period, using these allocations that we've already stipulated, we had a return of about a little over 11%. average annualized return. And then you can see all 26 25-year returns. And the median is the dark line here, the black line, about 10%, 10.10 to be exactly correct. So that's the median return of that type of portfolio, about 10%. So that's just a quick little summary of the spreadsheet. So now with that much of a background, let's now jump to the live spreadsheet, and let me demonstrate a couple of things that I hope will be of value to you. So now we're in a live spreadsheet. So I'm going to put 72 as the age, and I am going to put as the starting balance $1 million. And let's just say it was all in cash, just to start kind of the whole process here. And let's say that the expenses associated with that are 25 basis points. Let's say 50 basis points. Okay, so let's look at the graph here. The blue bars represent the balance at age 97. And we notice that the blue bars never go below 0. So right away, that's the first thing we're looking for, is where are the blue bars going? If they're going below 0, we ran out of money. If they're not below 0, we still had money left at the age of 97, assuming we're starting at 72. Well, if you're currently 80, then everything changes. So the red dots are the portfolio balance at 80. Okay, well, we've stipulated that. So for all 26 different retirees, we've said each retiree is going to start with $1 million. Here's what their balance was 25 years later at the age of 105, assuming they had this whole 25-year period invested in nothing but just cash, a money market fund. And now the purple triangles represent how much was taken out over each 25-year period. So over the first, so from 1970 to 1994, a total of 2.187, you can see it there, 2.2 million was withdrawn. Okay, well, they started with $1 million, and they ended with 328,000 25 years later. So I think that's pretty remarkable that based on the RMD, which is now what we're using, and there's an RMD table right here, and so you'd be using, if you start at 72, you have a 25-year period, then you're using those percentages right here. Your first withdrawal would be 3.906, starting today and going forward, and then 4.049, 4.202, and so forth. Those are your withdrawal rates dictated by the RMD. And that's what we've chosen here. So this analysis we're looking at is based on RMD. And my big takeaway, as I look down at the numerical results, every retiree, there's 26 of them, started with $1 million. The average withdrawal was 75,000. The high was 95. The low was 52. Again, that's the highest average. The total amount withdrawn, on average, over the 25-year period is 1.89 million. The highest amount withdrawn was 2.387. That was right here. And that was 1978 to 2002, that particular window. The lowest amount withdrawn was 1.3 million. And that's fascinating to me. You started with $1 million. The least amount taken out was 1.3 million. And the average ending balance 25 years later was 207,000. The highest ending balance was 329. Looks to be right in here somewhere. Probably right here. There it is. In that particular 1973 to 97 window. So that's a little orientation to the graph. let's now set up a more reasonable portfolio. Let's say there's a 15% commitment to large U.S. stock, 15% to small, 10% to non-U.S. stock, 30% to bonds, 20% to cash, 10% to real estate, and 10% to commodities. Now, if we did that, then it's going to warn us, whoop, you went over 100%, that pink. So we're going to have to back off. Let's go to 5% commodities, maybe 5% real estate, or actually 10% real estate, and let's go 25% bonds. So it's close to a 50-50 portfolio in terms of equity and fixed income. It's 45% fixed income and 55% equities and diversifiers. So with that allocation that we've now imposed, the annualized return over that 50-year period from 1970 to 2019 was 8.62%. That's what that portfolio did historically using these indexes right here. They're all laid out for you. The median 25-year return was 9.89, and that's that graph I showed you down here. So we have two ways to think about returns. We have an entire 50-year period that has a single geometric mean return, a single average annualized return. The challenge with that is that, you know, not a lot of us will have the same portfolio design for 50 years. People tend to change their allocations, you know, as we age. And so a single 50-year or 70-year return for a portfolio isn't terribly realistic, but what's more realistic is, okay, what was the return of that portfolio over, say, rolling 25-year windows? Because we might have a similar allocation for, say, a 25-year period during retirement. And that's what this graph is trying to get at. And so with those allocations that we just imposed, here's that median 25-year return. So here's all 26 25-year returns, and the median is the black line. So obviously some years were higher than the median, some years were lower, but it gives us a sense of, okay, how does a portfolio like that tend to do over a relevant time frame such as 25 years? So right now we have 50 basis points as cost. Let's say it's 75 basis points. And right now we're showing the results assuming RMD. Let's go back to age 72 for a second. So at age 72, person just starting out, they're now being exposed to the RMD requirements. Here's the experience. So if you could go back and relive being 72 26 times, and each time you relive, you move the calendar forward 1 year. So your first run at a 25-year retirement was 1970 to 1994. Think of it that way. Each one of these bars is you, but it's a different you starting 1 year later. So in every case, you started with $1 million. All right? That's the red line. But as we notice, the 70s and 80s and 90s, boy, we finished that 25-year retirement period at age 97 with a lot more money than we started out with. And that's another thing to really key on as we begin to change the variables more and more, and you're looking at this graph, is when the blue line is above the red dot, that means you finished at age 97, or in this case, whatever age, 25 years later, with more than you started with. And the purple line represents how much you took out over the 25 years. And if you'll just consider what this graph is telling us, it's extremely optimistic. It's extremely comforting that the RMD, at least over a 25-year period, doesn't kill a portfolio. And we've accounted for a variety of circumstances. For example, the first time 2008 factors in is right here, 1984 to 2008. Well, look what happened. The ending balance, again, we're using the same RMD withdrawal rates for each of the 25 years in all of these rolling 25-year periods. So the only thing that's causing a difference between the ending balance that we had in 2007 versus the ending balance in 08 is what happened in 08. Well, that's a classic example of the sequence of returns. It just so happened that we had a really, really ugly return the very last year of our 25-year period. We went from an ending balance of 1.79 million to an ending balance of 1.15 million. And then, in all of the rolling periods after 2008 makes its appearance, 2008 is still in that data, still in that experience. Now, let me just do what I'm assuming some people want me to do here, which is we've got a 25% allocation to bonds right here. Okay. And the thought is, wow, 7.4% was the 50-year return for bonds from 1970 to 2019. And your thought is, and I would agree with you, that the future return of bonds probably isn't going to be nearly that good. So why don't we take 300 basis points off the historical return of bonds? Okay, with that in mind, maybe you want to jot down a couple of numbers. So in this analysis right now, we started with $1 million. That's not going to change. What we're going to want to see now, once I type in minus 300 to drop the bond returns down in this analysis, you're going to want to see what happens to the average annual withdrawal, which is 134. You're going to want to see how much the total withdrawal changes. It was 3.3 million now. And then the average balance at 97 is 1.76 million. So I'm going to jot those down with you so that we can appreciate the impact. So we're at 134 average withdrawal, 3.3 total withdrawal, and 1.76 ending balance. Let's now drop the returns of bonds by 300 basis points. So our average withdrawal goes from 134 to 120. Our average total 25-year withdrawal goes from 3.3 to 3 million. And our average portfolio balance goes from 1.76 to 1.47. So is that catastrophic? No. But we have to consider that bonds is only 25% of the portfolio. And so even if we cut the return almost in half, it doesn't destroy the outcome of a diversified portfolio. Well, let's go to the edge of the universe then. Let's take everything down by 300 basis points. See where we get. Okay, so if we drop the historical returns now all by 300 basis points, 3 full percentage points, our average annual withdrawal goes from 134,000 to 87,000, so that's a material change. Our total 25-year withdrawal on average goes from 3.3 million to 2.2, and our average ending balance goes from 1.76 million to about 840,000. So we knew it was going to lower things, but I suppose one thought might have been, well, it's going to crush. I'm going to run out of money. No, the RMD, if all you take out, and what this is assuming is that you're only taking out the RMD. You're not taking out more than the RMD. That's a key point. That doesn't allow the portfolio to be crushed, because when you only take out a percentage, and if the portfolio went down in value because of bad returns in the markets, that means even though the RMD percentage went up the next year, if your portfolio value went down more than the RMD percentage went up, you're going to take out a smaller amount of money than you did the prior year. And that's where we get this result up here. 70% of the time, the withdrawal increased the following year. Well, that means that 30% of the time it went down. And that's what protects the portfolio from being liquidated, is that you don't force an increase in the withdrawal. And there are some systems that we can set up that will do that. A fixed dollar start, and then a COLA, a cost of living adjustment, applied to that starting dollar amount of withdrawal, and it forces into motion a system of withdrawals that you actually know in advance. You don't even have to know what the portfolio did, because if you set in motion that you're going to take out $40,000 the first year, and then 3% more than that the next year, then it's an unrelenting march upwards, and that system of withdrawals is completely blind to how the portfolio is being affected by market activity, positive or negative returns. The RMD is very aware of what the portfolio is experiencing because it's only taking a percentage. And so I hope that the big takeaway here to this point is that the RMD actually protects a portfolio from being liquidated. Now, we don't have to use RMD. Okay, what we could use is just type in 4%. Okay, so if all we do is take out 4%, that's kind of the classic 4% withdrawal rate. So whatever the portfolio's value is at the end of each year, we just take out 4%. Okay, you see what happened? Wow, everything just improved. I'm going to go back to RMD real quick. Okay, if you're just watching the blue bars, and again, we have our historical adjusters in there. So let's take those out for a second, and we'll go RMD, and then we'll go 4% again. And now our average balance 25 years later is 3.7 million. So there are other ways. So those are two. RMD obviously affects a lot of us. There's a lot of retirement money is in accounts that are governed by RMD requirements. But there's other accounts that aren't, and so that's where we can use a 4%, a 5% withdrawal rate, a 6% withdrawal rate, 7. Let's go to 10. Does 10 kill the portfolio? No. Obviously, it hammers it down. So if you're watching the blue bars, now we went from, well, we were at 4%. We were a 3.7 million average balance at age 97, a 10% withdrawal rate, 864. So, huge impact. But again, the takeaway is the blue bars never went negative. I'm not advocating a 10% withdrawal rate, obviously. I'm just illustrating that if you're only taking out a percentage, then the portfolio is allowed to heal because, look up here again in the top, 56% of the time, your withdrawal increased the next year. But that means 44% of the time, it went down the next year. And the average amount of decline was $8,700. The average withdrawal was $105. So if you sort of triangulate on that information, if our average withdrawal is $105, and roughly half the time our withdrawal went down, and if the average was $8,700, then $8,700 as a percentage of $105 can you live with that? Is that withdrawal, that average withdrawal, large enough that it really crushes your budget? I can't answer that for you, but you can relate 105 as the average withdrawal and 8,700 as the average decline in the withdrawal the next year to visualize or think if that's doable. You can live with that. Let me show you one more option, and that's if I enter a 0 in this box like I just did, it opens up. Let me go back to 4%. So at 4%, this box down here is blacked out. Well, if I enter a 0, I now can enter a fixed dollar amount. Let's say that I've got $1 million to start with, and well, let's leave it like it is. So 150,000 was already in there. So how does that work? Well, let's see. If I started with $1 million and I pull out 150,000, that means the first year my withdrawal rate is 15%, at least of my starting balance. And we can tell that things did not go well. All of the blue bars have now turned white, which means that they're negative, and we are deep in the hole, which we can't really do that, but I mean, it's just conceptually, you're now almost $6 million in the hole because that was way too much of a withdrawal. So if we go to, say, $50,000, okay, well, that worked. And in this ideal 1975 to 1999 window, wow, it really worked. That person, you, during that time frame, that sequence of returns, started with $1 million, took out, that's the purple bar here, you took out 1.25 million, so you took out $250,000 more than you started with, and you ended with 12 million. And that's just how it works, using index-based returns. And if you're an ETF investor or an index fund investor, that's what you're getting, minus a cost that we can account for in this box right here. So that's the essence of the engine, and I feel like I maybe should take a break and see if there's any questions at this point or types of analysis that people would like to see, if there's a way of communicating that.
Yeah, absolutely. We have a few questions. One of the most common questions had to deal with inflation, and a few different questions. One of the questions was simply, how is the model accounting for inflation? I guess, is it the same starting amount each period?
Yeah, so my answer may not be pleasing to everyone, but what the performance of the portfolio, let me start again. What we're having to do is we're looking at historical returns. Now, it just so happens that we have 50 years worth of returns. They start in 1970 for all these indexes right down here, the S&P, the Russell 2000, the MSCI, EFA index, and so forth. All these different indexes, we have those historical returns. And we have them, we have 50 years worth. When we're doing this kind of analysis, we don't really care when they occurred. We just want to see the variety and the sequencing of the returns, because the only reason we're looking at this is to get a sense of going forward, how much havoc does the potential sequence of returns in a portfolio, how much havoc can that wreak on me going forward? In other words, I think what troubles people is that I'm setting a starting balance of $1 million back in 1970, and I'm starting with the same balance in 1995. And you're thinking in your mind, whoa, $1 million was not worth nearly as much in 95 as it was in 1970. You're right. But that's not really what we're focused on. We're focused on the sequence of returns. And we sort of we kind of set aside, and this is hard to do, we set aside inflation. Now, one way to deal with inflation, if you want to, I have a little different spreadsheet that now accommodates a COLA. So let's just take a look at this. So it's the same format you've been looking at, but in this case, we're looking at rolling 20-year periods. And we're starting in 1980. And there's a reason for that, but I won't bore you with it. So we have 21 retiree periods, 20 years each. And in this case, we can impose a cost of living adjustment. So it's a similar set of assumptions. Age 72, starting balance of $1 million. A diversified portfolio just happens to be equally weighted. Let's say we have 75 basis points of cost, and we're taking out, say, $40,000 a year is our first year, and then we're adjusting that $40,000 up by 2% each year. Or it could be 3%, it could be 4%, whatever it might be. So that's a way of accounting for inflation going forward, rather than trying to equalize the purchasing power of the starting balance back historically. I hope that made sense to people. In other words, one option is for me to take these dates off of the x-axis and just say, here's a sequence of returns. Doesn't matter when it happened. Here's another sequence of returns. Doesn't matter when it happened. And basically say, okay, we're just looking at what was the max, what was the min. That gives us now a sense of, and it's down here as well. Here's the highest ending balance. Here's the lowest ending balance. And don't worry about trying to inflation adjust dollars through time, because that's not. Because really, we're using this tool to look forward, but we're using historical data to give us that window forward. But again, if you want to explicitly account for inflation, you can do it like this by imposing a COLA, or you can say, you know what? If I'm taking 4% out, and my return is my median 25-year return is 9.6%. Obviously, I'm in good shape there, right? In terms of averages, you know, if your 4% withdrawal rate is sort of designed in your head to at least keep up with inflation, which it likely will, then your withdrawal rate itself is inflation adjusting on its own, because 4% is above the historical CPI going back, this 50-year period. And then if the return of the portfolio is ahead of the inflation rate, which 9.6 is, then the inflation is sort of self-correcting, as it were. I hope that was a reasonable answer to the question, and it's a good question, because it's hard to separate ourselves from inflation. But what we're really wanting to do here is see the variability over time and not get and force ourselves not to confound it with the inflation issue.
Great, thanks, Craig. Another question I'm getting a lot is there's a lot of interest in your spreadsheets, and a lot of attendees are wondering if it's available, and if so, how do they get access to it?
You can contact me directly, and let me just pop up the email. It's something I sell normally for $250, but I am very comfortable, given my experience with AAII, speaking at, dozens and dozens of chapters. I'm happy to sell it at half I'm happy to sell it at 125. I've spent probably, I don't know, 8 or 9 years developing it off and on, and then pretty intense application recently getting it finalized. So it's 125, and you're welcome to email me directly, Craig@712portfolio.com. And I think that the biggest, I use it in my research. So I write for Financial Planning Magazine, write for Horse's Mouth, I write for journals. This is a tool that I use personally in my research because, you know, if I were to only show the results from 1975 to 1999, for example, wow, things look pretty rosy. And so I'm very suspicious of research that only shows one time frame of a retirement withdrawal scenario. I mean, that's really why Monte Carlo was developed, is to get away from a single time frame, single time periods. But I really like looking at actual historical data, and so I've tried to blend the Monte Carlo world with actual historical data, and this is what I've come up with for my own personal use. And I will say, this is only one tab of 3. Here's another tab that goes back to 1926. We're limited to 4 asset classes. And this also has an accumulation calculator built in. Then there's another tab that has a different visual approach to this whole scenario. And you can also implement, well, let me show you. Okay, so it's 3 tools in one, in essence. And I've just been showing you one tab because I like this tab, but they all have their purpose. This one here, I think, is quite interesting. Let's start with that same $1 million. Let's go to, we make our choices in the bright yellow boxes, same kind of format. We've got our annual expense right there, 100 basis points. So now this is a non-RMD option where I'm specifying, say, a 4% withdrawal rate and a 3% COLA. And I'm showing this now because the inflation question came up, but I would rather deal with inflation on the withdrawal side rather than trying to, you know, somehow inflation adjust all the different starting balances that back through time, because I think that really confounds the issue. Let's say we have the same equally weighted portfolio, just for convenience. And then we can adjust the returns here as well, down or up. So in this scenario, now we have kind of this Monte Carlo look. Our starting balance was $1 million. The average ending balance was $5.8 million. And these are on rolling 25-year periods. The minimum ending balance is 1.4, max 12.899. The average withdrawal, the average total amount withdrawal. So it's a lot of the same information as this tab right here we were looking at. Just a different visual look for those who respond to this kind of graph a little better. And then, since there's lots of different ways to represent this, here's our max annual withdrawal. Well, if we're taking out 4% and a 3% COLA, that's one of those approaches where we know in advance what we're taking out because we know our starting balance, we know the initial withdrawal rate. If we COLA it each year, then we know in advance what we're going to be taking out each year. And so this is the max withdrawal, the average withdrawal, the minimum. So that only gets interesting when you go to, say, the RMD. And then the RMD, then you start to see the wide variety of experiences based on sequence of returns. And the sequence of returns is just something that we can't control it necessarily. But if in the analysis we can say, wow, you know, I've looked at all the different rolling periods here, and I can live with the worst case scenario, with the worst case sequence, which frankly have been occurring recently, then that's quite helpful. Another approach is the ending balance as a function of the total amount withdrawn. Another visual approach, because I never know what kind of graph is really going to be appealing to people. The green bar is the average ending balance. The blue bar is the maximum ending balance. The pink is the minimum ending balance. And the black line is the starting balance. But this is done for each year of the 25-year period. And so the average withdrawal, the average ending balance in year 5 was 1.44 million. The smallest ending balance was the pink dot, just over $1 million. The largest ending balance was 1.8. So it goes year by year. And what's kind of interesting is that using the RMD, which we've now invoked, that about year 18-ish or so is when you start to see a decline in the ending balance on average. And so that's an inflection point that you only get by looking at it this way. And then there's one more graph that shows the figures quantitatively. And then for those who like tabular data, here's all the same information, but shown in a data table. And the average ending balance, well, in this case, not average, it's the actual ending balance in that 25-year period of 1970 to 94, the average withdrawal annually, the total amount withdrawn, the after-tax annual income, if you impose a tax rate, and you can enter that yourself, the first year withdrawal, the last year withdrawal, and then everything's inflation adjusted over here in this section right here. So I'm not trying to ignore inflation, I'm just trying to deal with it more on the back end rather than trying to equalize all the starting values to account for inflation. So anyway, I'm kind of rattling on. Are there other questions that I can address?
There's a couple. One has to deal with taxes. I presume all your numbers assume tax decision is separate of the withdrawal, correct?
Yes, that's correct.
And then the other one I'll ask, and this is a little bit of a twist on it, but if somebody has a Roth IRA, or for instance, say they're withdrawing pre-age 70 and a half, or now pre-age 72, how does that affect the withdrawal decision? So if they're in a case where maybe the RMDs don't apply to them.
Yeah, good question. Well, they have a couple of options. They don't have to withdraw, for one, and so that can be a kind of a legacy account for children, church, whatever, university. I guess the way I would think through that is that you could do one, for example, set up the scenario for just your RMD accounts. So let me do that in caps, it's better. So maybe in your RMD accounts, you actually have 750,000. Okay. So you can do the analysis, assuming $750,000. And then if you had, say, $250,000 in RMD, then you could do a separate analysis for that, and then should sort of merge the results. You'd have to kind of keep notes, on your own as to the outcomes, but you could sort of divide and conquer your portfolio. And in that case, you wouldn't use the RMD. If this is the Roth amount, you would come down and say, I'm going to enter, say, a 4% withdrawal rate. So the RMD wouldn't be relevant in that one. Or you say, you know what, I'm going to put 0, and I'm just going to withdraw from that one, say, $5,000. Whoops, that's not going to work. So 5,000, and your average ending balance in the Roth is about 1.9 million, assuming $250,000 start. And of course, you can adjust the age. If you're 80, okay, then you can enter that. But that's not really going to factor in because the spreadsheet doesn't really care how old you are unless it's the RMD, and then it does care. All it cares about is a starting point, and then what happens over 25 years, and then a balance 25 years later. But let me change this back to RMD so you can see this in action. The RMD cares completely how old you are. So let's go back to the $1 million. Let's add one more zero. Okay, if you're 72, all right, so if you're 72, then based on history, if you start with $1 million, you have this particular portfolio set up with those allocations, then you had on average about 1.8 million 25 years later, okay, at age 97. Well, if you're starting at 80, then you have 653,000 left. Now you may have a different starting balance than $1 million, but I'm just trying to illustrate that as you change the age, if your analysis is using RMD, then you will really, really change the results. If your analysis is using a percentage rate, then changing the age will have no bearing. You could enter 500 years old and it's not going to do anything. So let me show one more thing. There may be other questions, but before I forget, let me go to RMD again. One of the aspects that I find super helpful in doing my research and my publishing, and I did one piece in the AAI journal where I think I went into, as I recall, it showed the impact of different cost levels, different total portfolio costs, because that is controllable. And so, and I'm preaching to the choir here. I get that. Very savvy investors and cost-aware investors. So if we go from 75 basis points, let's take a couple of notes here. Okay, so assuming all these things we've typed in, the average withdrawal is 134, 3.3, 1.76. Okay, so those same notes you took before, and that was with a 75 basis point cost. What if we could get that cost down to, say, 50 basis points? Well, I know you can. I mean, I build portfolios, and if I use low-cost ETFs, a lot of Vanguard product, Schwab has a lot of really low-cost ETFs. Fidelity has lowered a lot of their costs. I mean, I know you can get down to 10 to 20 basis points, building out a fully diversified portfolio. Let's just take it down to 50. Okay, so I'm now going to press return. Watch what happens, say, to this cell right here. The average annual withdrawal. Okay, if I go from 75 basis points to 50 basis points, I just picked up $5,000. So $5,000, that's almost $500 a month. Wow. And that's doable. Let's go to 25 basis points. Now I'm at 144. I just picked up $10,000. In terms of almost $1,000 a month by simply going to lower cost product. And boy, I just love seeing that because that's one of the things we can control. I mean, we can control our asset allocation. It's our choice. But we don't control the returns of the asset classes. I mean, if we did, we'd all be exerting different control over the last 10 weeks, right? We wouldn't want to see what we're seeing. But we don't control that. But cost, we do control. And so I would really encourage, if you feel like you've got some ETFs or funds in your portfolio where there might be a lower cost option, you know, this allows you to quantify the impact of that. Other questions, Charles?
Yeah, one of the questions that people are asking just about what if you had a longer retirement span? Say you retired early, say at age 60, and you assume you're going to make it to 100. Obviously, considerably longer than rolling 25 years.
Yeah. Yeah. Well, that's the beauty. So here's the conundrum. So if I went with, say, 40-year periods, I would slash the number of research time periods that I have to work with. In other words, the longer I make the time frame, the withdrawal time frame, the fewer rolling periods I have to work with. And so it's really a dilemma because I really understand the question, and I would like to be able to portray a 40-year period, but I hate to lose n, sample size. So here's what I would suggest: if a person retires at, say, 60, okay, so at 60, now this is going to kind of freak out with the RMD chosen because 72 is the minimum. So I'm going to change that to a 4% withdrawal rate, and now it'll behave. So at 60, you conceivably do have a 40-year period. You live to 100. Okay. Well, this gives you your look for the first 25 years of that 40-year period. And what it's telling us is that by 85, it looks like we're going to have on average about 4.2 million. We could, historically, during that sweet, 1975 to 99, we had over 8 million, whereas in more recent years, we have one period where we were down to 1.7. So the worst case scenario historically is that using a 4% withdrawal rate, excuse me, you had 70% more than you started with 25 years before. That's the worst case scenario, historically speaking. I love that kind of worst case scenario where you're 70% ahead, your ending balance, relative to where you started. And then at 85, you run the scenario again. You enter 85, and by then, maybe you have 2 million, and you go to the next segment. So what I'm saying is that not many of us would invest for a 40-year period, invest and then turn away, and 40 years later come back to see how it's doing. Now that might actually be a good idea, but most of us don't do that. And I think retirement analysis is probably similar. And so the way we get around the inability to look at a complete 40-year period is that we just are, frankly, in my mind, a bit more pragmatic, which is, let me look at it. Well, let's say you think you have a 50-year retirement window. Okay, well then look at it in two halves, your front half and the back half, and acknowledging that certainly during that 25-year period, the first half of a 50-year period, you're probably going to make some changes along the way. And so, to want to see a 40 or a 50-year period probably isn't very relevant because whatever you're imposing as your allocations, whatever you're imposing as your starting balance, my hunch is that even 5 years later, 10 years later, there might be some changes made. Think about it in terms of cost. Even 10 years ago, 10 years ago, building a portfolio for 20 basis points was really hard. Now it's really quite easy. So in other words, this tool, it's not a one and done look. It's probably something that a person might, use this tool every couple of years as their situations change, as their balance is changing.
Well, actually, that leads to a question that I've been getting asked. So I've done some modeling too, and particularly when sequence of returns is favorable, a retiree can end up far ahead of their plan. So at what point, I guess, does a retiree look at their balance, and if they have more than they're expecting, at what point do they decide, have a decision, maybe I increase my withdrawal rate, maybe I go on that huge vacation, or maybe I consider setting some aside for inheritance? I guess at what point do people look at their portfolios, or should they, and decide if a change needs to be made?
Yeah, great question. In fact, there was a question beforehand that was emailed in referencing the Vanguard. I'm trying to go to it here. Anyway, I can't. I was trying to. It's the Vanguard. Where did I put it? Dynamic withdrawal, something or other. Anyway,
With the floor and ceiling. We'll link to it. We'll link to it afterwards. We'll have that in the show notes.
Okay.
The floor and ceiling.
Okay. Yeah.
Yes.
Floor and ceiling. Yep. And that's a good idea. I like that because it but I think people do it kind of on their own anyway. I mean, this is a planning tool. This is just an overall sense of, am I going to blow up after 12 years? Is my portfolio going to implode? And everything we've seen so far says no. And everything we've seen so far is accounting for years like 08, 01, 02, 2000, 73, 74, 2020. Right? 2020 has been fully accounted for in the analysis because we've had years like this in the past. And it did not break the portfolios. But the key is that we've been primarily focused on, without explicitly saying it, kind of a floor and ceiling approach. Meaning that if you're only taking out 4%, then you are, like, after a big year, after a year like, say, 1996, let's say, well, the last half of the 90s, right? You could have, the S&P was averaging, what, 24% for 6 or 7 years in a row? And so, sort of in theory, if you're largely an S&P 500 portfolio, you could have taken out a 15% withdrawal rate, and it's only, or say a 12% withdrawal rate, and that was only half of what your return would have allowed you to take out if you're fully taken out your performance that year. And so, a 4% withdrawal rate is a fairly modest withdrawal rate. That's already sort of a very low ceiling, so to speak. But I believe that people have enough sort of internal logic that after a really good year, maybe you bounce it up to 5%, with no intention necessarily of keeping it there. So it's a dynamic percentage. And the notion of a floor probably is just acknowledging the reality that, our withdrawal can't go to zero if we're living off this account. And so you might have a fixed dollar amount that represents the floor, sort of a maintenance level budget. It's probably easier to think in terms of a fixed dollar amount. Maybe it's $60,000, let's say. And so if you did analysis where you're just, not 600, wouldn't that be fun? 60,000 is a floor. Well, all that's, in this spreadsheet, all you're doing is now studying the floor. And that obviously works. If you're starting with 2 million, you're only taking out 60,000. You have $32 million left over. So I think as a person becomes familiar with this type of analysis, there's just a natural sense of, 3, 4, 5% withdrawal rate. There's a reason why those rates are commonly talked about in the literature, is that they are sustainable. A 3% withdrawal rate, you just won't kill a portfolio. And so after a year like 2020, you dip down to a 3% withdrawal rate. After a year like 1996, maybe go up to a 5% withdrawal rate. But I think the key is to not overcomplicate it, because I look at myself, I look at my parents. I'm 61. My dad's 94, and I don't see myself responding better to more and more complicated things as I get older. I don't know how to delicately say that. So whatever you do, keep it relatively simple. So if you have a 3% to 5%, withdrawal rate bandwidth, that's really simple. And you'll know how the portfolio did, and if it did well, Another idea, I've never published on this, but is maybe whatever the portfolio did the prior year, take out, if it did a 15% return, take out 5, take out 1/3 of it. If it did a 10% return, take out 3.3. Just take out 1/3 of whatever the portfolio's return was. I mean, that's how you keep a portfolio alive for a long, long time. And that's really easy to figure. I mean, that's a simple rule.
Okay, let's ask you 2 more questions. One concerns going forward in terms of returns, particularly on the bond side and even on the cash side, where we're looking at yields, at least for the short term, next couple of years being extraordinarily low. The question I'm seeing coming through is, how does that affect the calculations, particularly when you look at historical returns where interest rates were obviously higher, considerably higher in some periods than they are right now?
Yeah, so that's the beauty of this adjuster, that we can take, let's take 400 basis points off the bonds. So now they're going to be, so now we're saying by imposing a 400 basis point reduction, that bonds actually did 3.39 average annual return over the last 50 years. So let's say that there's a notion that bonds are going to do even worse than that. So let's take 500 basis points. They're going to average about 2.4%. All right. So now as I type that in, you see the results. It has a small effect, a small negative effect, but the key is it's small. Now, if your portfolio is all bonds, well, obviously I can tell you that that's going to have, a pretty dramatic effect. So here's an all bond portfolio. Let's set it back to 0. Okay, so an all bond portfolio, and this is kind of to the point of whoever's asking the question, bonds have done pretty well. Yeah, they have. So if you account for fees, 25 basis points of fees, bonds did 7.15 over the last 50 years. Gross net of fees, 7.4. So if I go to, say, minus 500, all right, well, that obviously had a big impact, but this is an all bond portfolio, mind you. Did the portfolio ever run out of money? Nope. And I'm taking 60,000 out a year. Well, let's change that to a percentage. What if I take out 4%? Nope, didn't kill it. I'm taking out 4%, and I'm investing in an asset that did 2.39, and it still didn't kill it, because that's how a percentage withdrawal works, is that it protects the portfolio. And so the lower anticipated fixed income returns of bonds and cash, and we could take 200 basis points off of cash, and let's make this a 60% bond, 40% cash portfolio. And we're always looking at the blue bars. Did I have money left? Yeah. What if it's RMD? Yep, not a lot. All right, my average balance was $80,000. And so the RMD is going to be a lot harsher on a portfolio than a fixed 4% withdrawal. Well, but we've kind of set ourselves up for destruction here by having such a conservative approach. If we even had, it's really interesting, if you just have even 5%, and then 5 to REITs, 5 to REITs, 5 to commodities, let's adjust that down to, say, 40 and 20, and maybe that 35. Anyway, you get the idea. Just having a little bit of exposure to equities is quite helpful in terms of average ending balance, in terms of average withdrawal. And so the ability to adjust the asset allocation to what you're comfortable with ought to be, I mean, there ought to be a way to look at the different allocations and what they've done historically to then settle on an allocation you're comfortable with. And that's really what this allows, is to do dynamic, real-time decision making based on all the history. I mean, we can't go further back than 1970 for some of these asset classes. If it's just large U.S. stock, yeah, we can go back to 1926. But most people are building more than just, large U.S. stock and bonds and cash. They've got non-U.S. stock and real estate and so forth. So I think I maybe long-winded the answer, but you can adjust the historical returns as down as far as you want, and then see that impact historically to give you a sense of what the future may look like for that particular asset class as a component of a portfolio.
Great. And then the last question I'll ask you, just for your email address again. I'm seeing a lot of questions specifically about the spreadsheets.
Okay. Yeah. So Craig at 712 Portfolio, CRAIG, and then 7 is just the number 7. 12 is spelled out as a word. Portfolio.com.
There you go. And I'll point out that Craig's written several articles for the AI Journal. We're very grateful for that. You can certainly find out in a lot of the research he's talked about today is discussed in the journal, as well as the 712 portfolio and the allocation. So you can certainly see a lot about that as well. Craig, it was great talking to you again. It's been a while. I know. Hopefully in 2021, some of the travel restrictions will be lifted and we'll get a chance to see each other in person.
Oh yeah, I would certainly enjoy that. I was looking forward to the Las Vegas conference in the fall, and anyway, yeah, we hope for more normal days ahead. And I do want to say, for those who are having interest in the spreadsheet, I'm happy to answer questions down the road, as you work with it. I'm a teacher at heart, and I just don't. I'm not uncomfortable receiving emails from people I don't know. I mean, I'm comfortable helping where I can. I'm really taken by the messages we see a lot of places on marquees of stores and so forth, that we're in this together. We can get through this together. That's kind of how I feel about retirement, is that we are in this together, and that I'm not. This is going to sound really maudlin, but I am desirous to help, and how I can help is to try to develop tools that empower people to make decisions that they're more comfortable with, and decisions they feel more informed about. So I'm delighted to have the chance tonight to share some of this. Thank you.
Great. Thank you so much for joining us. To all the attendees still with us, we appreciate it. I know many of you have stayed with us. We're going to continue doing these Wednesday webinars. Next Wednesday, my colleague Wayne Thorpe will be talking about our factor investing with our A+ investor service. I will be on Wednesday, July 1st, possibly with a bow tie. We'll see what popular demand asks for. But I'll be discussing our brand new AAII way for creating wealth, and going over some of the initial worksheets we've created and the thought process behind them. I wish everybody good health, stay safe. And again, thank you so much for showing up tonight. We truly appreciate it.